Okay, so this is the last part on the Applied General course. Question 11, which is out of 20, which is 1/3 of the total marks. And here we're looking at the Kid Store PLC. Now, this particular company was thinking about whether or not they should create a new shop, spend more money on their online presence, so they're going to have to borrow some more money, and whether or not this was a good idea or not. So fundamentally, they need to borrow 100,000 quid to buy this new shop. The cost per year the loan repayments on that would be £20,000 per year. So obviously your gearing would go up, and the higher the gearing, the greater the risk for the firm. Now, when you're given some numbers, these are numbers given on this paper, it always tells a story. So we look at them very, very quickly, and we tell the examiner about them. Well, the business is doing much better than it was previously, because the return on capital employed, which the amount of money that you make in terms of money that's been invested in the business, has in fact gone up. Now, that's quite a considerable change from there, and 9% is a reasonable rate of return. The gearing has gone up ever so slightly. It's still low though, it's not very much. If they want to borrow more money, then the gearing is therefore then going to go up. Then they're going to pay more interest payments. The current ratio, we all know what that should be. That should be 2 to 1. We need to tell the examiner that. Here we've got £1.74 worth of current assets for every £1 worth of current liabilities. If it's the asset test ratio, remember it should be 1 to 1 on there. So there's a slight liquidity concern here. The stock turnover has gone down ever so slightly. This may signify that they may need to change. This means they turn over their stock 9 times a year. This means they turn over their stock 8.8 times a year. So therefore stock turnover has gone down. This is not as good, but overall their profits have in fact gone up. Now, if you look at their profits, we can then say, well, if they're making £68,000 a year, then they should be able to pay the loan repayments of £20,000 a year, and it's not putting the business at risk. So we look at this overall and we say, well, this is generally fairly favourable. The business is now doing better. Should they expand into a new shop? We need to look at the marketing information on there as well, which will be on the question paper. But that is just analysing the numbers on there. Let's do one more on here. Okay. So the last one today is, so this was HSMT, and they were small cinemas based in town centre locations, and whether or not they would work or not. Right, so we look at this on here. Gearing is still fairly low for this business, 27%, gone up to 29%. The current ratio was very dangerous, 0.52 to 1. This has improved a lot, but once again, there is a slight liquidity problem here. Not as bad as when it was 0.52 to 1. It's now 1.57 to 1. It should be 2 to 1 again. The operating profit margin has in fact gone up, so this is a good sign for the business. Therefore, the business is doing better. So what they're doing correctly, which means they're making more money. And lastly, the net assets, the business was worth, in 2018, it was worth 16 million quid, and now it's worth 25.67 million pounds. So business is clearly getting better. Now, the then question says they've been offered 30 million pounds this business, should they sell? Well, in one case they should do, because it's worth more than the business is worth. So they're going to make money out of that deal. Secondly, but we don't know how much profit they're making. We know what the profit margin is, but not how much profit they're making. So £30 million, maybe not such a great deal. If the marketing information is going in their direction, which it is when you read the case study, then probably they're going to stay with the business. Now, this is crucial. For your conclusion, you must make a decision. Yes, they should keep doing what they are doing. No, they should not sell. In fact, in this case, they were thinking of buying 12 more cinemas or 10 more cinemas. They should continue on their current line because the business is doing really well. The marketing information is good. The financial information is good. So therefore, they should continue in the same way. And if you do that, you will in fact get 20 out of 20, which is pretty cool. Right, thank you.